Good afternoon, everyone. Welcome. I am very excited today to welcome you to our latest edition of our Coffee and Conversations webinar series. I'm very excited today because we get back to talking shop, all about investing, economics, stock market, everything that I eat and sleep every day. First, I want to give you a little background on myself. My name is Joe Gallimore. I am the investment analyst for Argent Bridge Advisors. I grew up in Fairfax. I went to Johns Hopkins University up in Baltimore, where I majored in economics and applied mathematics. So that made for a very long 4 years of calculus and supply and demand charts. Now I am the dedicated partner in charge of investment research and investment research and portfolios for Argent Bridge Advisors. So I spend my days staying on top of investment strategies, pounding the pavement looking for new investments and opportunities, trying to stay informed on all of the economic topics, stock market trends, economic news, all of the factors that go into your portfolios. And the last and most important thing I do is hands-on work with your portfolios. Every day I look at clients' portfolios. I collaborate with the advisors. I make sure that what we're doing sets up the best possible outcome for your particular situation. So today we are having a bit of a technical glitch. We're waiting on our distinguished guest, but I'm going to introduce her and hope she gets here soon. Today, we're going to be speaking with Samantha Azzarello. She is an executive director and strategist with the JP Morgan Global Market Insights strategy team. The team's task is to take a lot of complex economic data and stock market numbers and turn them into actionable ideas for investment professionals like myself and for retail investors like you. The Global Market Insights team, they produce a lot of research that we use continuously, and they produce some of the charts that our advisors share with you in your portfolio review. So you may recognize some of those and remember those. Samantha has been with JP Morgan for the past 5 years. She has a background as an economist and as an investment strategist, most notably with Bank of America in their chief investment office. So she's been working on some high-level investment strategy for many years now. She has a degree in economics from the University of Toronto, and she also earned her master's degree in economics from NYU. And her concentration there was in econometrics, which if you don't know what it is, it's basically where statistics meets economics. And it would turn most of our brains into a tangled knot. So believe me when I tell you that she knows what she's talking about, and hopefully we will have her on soon. So until we have her on, I'm gonna get started talking about some of the topics that we wanted to cover, and hopefully we get her insight on these because she really has perspective on this from a very informed high level. So the market, it's been a crazy year so far. Oh, hi, Samantha, do we have you?
Hi, yes.
Hi, how are you?
Good, I was hanging out as a participant, so I was just listening, but I was here.
Yeah, perfect. Well, I hope you heard your hopefully glowing introduction. I tried my best to accurately portray your impressive experience. So especially your experience with econometrics, which was one of my tougher courses in college. So welcome, and excited. I guess we'll jump right into it right now. I was just saying that it has been one heck of a year all around, obviously with the humanitarian issues, but the economy shut down and even more haywire in the stock market. The market peaked on February 19th, I believe. Then it dipped 34% in a matter of about 5 weeks. Now it's recovered to all-time highs only recently. So my question is, with all that motion and being kind of back to where we were 9 months ago. Is the stock market today any different than the stock market back in February?
So really good question. It's been a lot, right? It's been a lot of emotions, and yet it feels like it never happened if you had just not looked at what your portfolio did, between March and now. The only thing that I would say is a little bit different is big tech. So we still love big tech. All of you who are watching, all of us, we still use big tech. But I would say it's a bigger piece of the stock market than it was in March. Not going to say if this is good or bad, but it's something I know we're all keeping our eyes on because we like to make sure that lots of things are pulling the market up and not just, 5 or 6 companies.
Right, exactly. So let me ask you, with that point, few stocks pulling the stock market up.
We've seen that happening a little bit, and we talked to our clients about exactly that point, actually. How might that unwind itself? Does it pose a risk, or is it just there's more opportunity elsewhere when things renormalize?
So you put it perfectly. There's other opportunities. So this is not, we're not abandoning tech, right? These names, these companies, this is nothing like 2001. I just want to put that out there. These companies have really good revenues, cash flows, good margins. People love and use their products, but there's always risks to imbalances. So I think about the way we analyze markets, the way we analyze the macro picture. We're always looking for imbalances. Like, show me something that's maybe growing too fast compared to normal, or maybe show me something that's like a little bit hotter than we're used to, and we just want to keep our eye on it. So that's all it is with tech. So we're not abandoning tech, we're not selling or getting out, but we just want to make sure that there's balance in the portfolio and looking to other places where there could be opportunity. And there's lots of places where there could be opportunity. So that's really exciting. Whether we're thinking about value stocks, international stocks, just lots of different things to look at. And I think it's just, that story is probably going to run its course with tech if you start to see some regulatory issues with the government deciding, hey, I think we want to kind of monitor and mandate what tech does or doesn't do. Because as of right now, tech has not been regulated.
Yeah. And I remember recently, a couple of weeks ago, they brought in the four CEOs of 4 of the biggest tech firms, sat down for a whole day in front of Congress. So hopefully that works itself out. But you touched on a great point, kind of pockets or themes that rise out of this. And when the virus started accelerating in the United States and quarantine became widespread, we started getting a lot of questions about, hey, what about healthcare? What about technology? These are the obvious things. Has your team seen any pockets or any other kind of mini themes emerge from kind of the large scale society changes that we've been dealing with?
Such a good question. So there's all these trends that were percolating, kind of happening, and COVID has effectively accelerated them. So we're trying to think, okay, we're going to get through this. We're all getting through this now, but what does the world look like afterwards? And there's a few things that have come up for us that we've thought through. And the first is a higher savings rate, which seems kind of random and like, where is that coming from? But we just think generational episodes like this really cause most people to save a little bit more. So if you're lower income and you're saving more, what does that look like? It probably means lower credit card and discretionary spending. So you think about discretionary companies, that means, that could be a little bit of a hit to their earnings or their outlook. If middle income, higher income people are saving more, what are they doing with that money? I can assure you they're probably investing it. So we think there's actually going to be more demand for insurance products, wealth management products, asset management products. So that's a pocket of financials where we're like, hey, that's kind of exciting, and that's a long run trend. Then there's a huge structural trend, which I'm really excited about, around sustainable investing. There's a lot of things sustainable investing can be and might not be, but it's growing, and it's a growing part of the market, which is really exciting. If you think about water companies that are helping with, infrastructure, sustainable electricity, all this kind of stuff. So I guess my point is there's reasons to be optimistic, and there's reasons to think that there's pockets of interesting things happening. And we still love tech. I'm just going to put that out there, but it doesn't have to be all about the big 5 tech names. That's all.
Right. Let me ask you an offshoot of that. You mentioned sustainable investing. We also get a lot of questions about socially responsible investing, which for everyone listening, it's run itself into a category in the industry we call ESG,
environmental, socially responsible, and governance. When you say sustainable, does that apply to any one of those? Is that a broader term, or is it, is it sustainable natural resources, which most people usually go to, or is it a society comment?
So it's it's like the umbrella term. I think sustainable investing also on a tangent. So I'm going to take your tangent and take us farther off onto a tangent.
Perfect.
I think sometimes it's hard for things to take hold and build momentum when seems like we're talking about different things. So there's been this movement, whether you're calling it ESG, which you defined perfectly, and I always have to do that too, because I'm like, what does it stand for? Or sustainable investing or impact investing. They're all flavors of the same thing, which is just this idea that we can either support initiatives and make money off of it, like positive investment returns, but basically just adding another lens or layer to the way we invest our money. And it can be feel good. It can be feel good with a profit, or it can be just purely for profit. Because if you think about it, there's been so many companies that have had mishaps, to say the least, when it comes to some of these issues, and it's hurt their stock price or it's hurt their industry. So sustainable, I think of as the broad umbrella term.
Okay, thank you for clarifying, because I often wonder that myself. So today, I hope I'm not the only one feeling it, but there seems to be this general sentiment in the air of just positivity. There's news of several companies have vaccine candidates in phase 2 and phase 3, economic activities picking back up. You see that with businesses reopening. Unemployment seems to be finding its footing. It comes down several percentage points with every report, which is good news. And of course, stock market's hitting all-time highs. So I want to toss out to you 2 what-if scenarios. If as anticipated, we find a vaccine for this in the first half of next year, which is kind of seems to be the consensus, do things continue as they're going right now with economic improvement and the stock market maybe, gaining several more percentage points between here and there? And what if the vaccine, for whatever reason, is delayed another year? Maybe the first quarter of 2022, how would that change things?
Absolutely. So when you think about this shock we're all living through, this is not like '08. And I just feel the need to say that because 2008 was a structural recession, which is a buildup of imbalances and a big boom. And this isn't even like 2001, which was more like a cyclical recession. This is event driven. So we're getting a recovery, a piece of a recovery, sheerly from the fact that we turned the light switch back on. So we turned the light switch off, everything shut down, we turned it back on, and we're getting a surge in growth. Now, the next piece we're in right now, it's a little bit of muddling. Like, I'm with you. I think there's lots of reasons to feel positive and there's lots of reasons to feel good. Just let's not expect this to go as smoothly as maybe we'd hope or like. So there's a few industries where they can't get back up to 100% capacity yet. They're figuring it out. There's other industries where they want to bring people back, but they can only bring a certain amount because of capacity constraints. So I think the point is we're now in this like middle muddling phase, and we're doing it, we're finding ways, and people are feeling better and spending more, which is key, getting their jobs back and spending more. And I'm with you. That labor market report was like the best news we could have gotten. Yeah. It was just wonderful news, like we need, consumers are the heart and soul of the economy, so we need them back and feeling good. And I know for many of you on the call, maybe you feel infinitely better than you did in March, and that might sound so hippy dippy and kind of like woo woo. Why does that matter? It matters because all of our micro decisions, what we're all willing to do, spend, do with our families, all of this rolls up into the aggregate, into the top line growth numbers. So I'm kind of in the view we're in the muddling, and we're still doing good considering we're muddling. And then as soon as we get the vaccine, we get the last surge in the recovery. So to answer your question very directly, if we get it early next year, which is what everyone's kind of pricing in and expecting, then this will just kind of continue on this recovery. And I think we'll get a surge. And if we have to wait a bit longer, let's expect some market volatility, right? And let's expect, some sentiment it's been a roller coaster with sentiment, but I think overall we're headed in the right direction. And the last thing I'll say is you're still going to see bad numbers sometimes. Like, let's just get ready for that. And when I say the number, I mean the level. But it's not about the level. It's all about the delta or the growth. So it's like, don't tell me about where we're at. Tell me about like what direction we're heading into. I've mastered like hand stuff on Zoom because, but you kind of know what I mean. So just like the levels, like the unemployment rate is still 8.5. That's not good, but directionally we came down from 14. So you know what? We're doing good, and we just have to keep getting people back to work. So I would just encourage everyone to look at the direction of change over getting caught up on the level right now in the macro data.
Yep, funny you mentioned that. I remember when I was young in my career during the great financial recession of '08, I remember Dr. Kelly from JP Morgan said, it's not the magnitude, it's the direction. And that's all you should pay attention to. So that's a good reminder. Good to hear that. I want to stick with stocks, but I want to ask you kind of into another arena. And I'm going to throw it out in sort of a game show challengey kind of way. Without using any terms that we might hear in a 200 level macro econ course kind of thing. Can you explain why the current environment is favorable for international stocks?
Great question. International
it's tough
stocks.
To simplify things.
I know. I was like going to use a bunch of words, and I was like, wait, no, that's not allowed.
Right.
So international stocks help us in our portfolio because they provide zig when everything else zags. So I'm referring to diversification, which is the holy grail of the way we invest. And you know, I kept mentioning the tech stocks, and then we hyper focus on the US stocks or what the S&P is doing. And the truth is that's not your portfolio, right? For many of you who are watching, your portfolio is diversified. You've got a bit of everything, right? And I think of it kind of like a closet almost. You know, at the end of summer, you don't throw out your summer clothes because you know you're going to need them again. Like you just don't. You don't get rid of your winter boots at the end of winter. And I want you to think of it the same way in your portfolio. It's really tempting, like, oh, international hasn't been working, I should get rid of it. No, you know, it's going to provide yin to the yang, right? And also the global economy is picking up, and there's a lot of reasons to think that international could start to outperform again. That's actually our view. But even if it doesn't, even if the US continues to do really well, which we want it to, but we do think international stocks are going to do better over the next 10 years than US markets, you have to have it. Also, I think about the growth in the emerging market consumer. That's really exciting, you know, and that's all happening in India, China, parts of Latin America. And then we can talk about Europe if you want to, but I'll pause there maybe.
We don't need to, right? Yeah, and I've actually heard some other investment shops mention that something that people here may not totally realize. I've heard them mention that other countries around the world have actually dealt with this better than the United States. You know, they in some places they've had more of a national response where everything was unified. The people were in line with the government, what they were trying to do, whether they took a harder stance on social distancing and shutting things down more quickly, or you know, more universally than we did in the United States. Have you seen that at all? Have you guys talked about that at all? Is that true?
You know what, we have talked about it. And, you know, we're just looking at the data, Other areas crushed their COVID curve and the US has not. And it's really unfortunate. But we have not crushed our COVID curve, and we could be growing faster, full stop, period, without a doubt, if we had crushed our curve more. And I'm Canadian, so I'm just saying that. And, you know, Canada and US, they keep grouping them together in that North America line. And I'm like, let's not, because Canada's line is like this. So, but you know, Canadians are polite and they listen, so it's just a whole thing.
Sure.
But yeah, like Europe crushed their COVID curve, and they're having a little bit of a resurgence, but it's through trial and error of trying to reopen and kind of pivot. Or I think about parts of Asia that have been really good about shutting down, taking stock of what's going on, and then moving from there. So we want US number of cases. On average, they've come down from 70,000 to 45,000, but we need to see more progress. And the thing is, you know, the world is rooting for the US because the US is still the biggest economy. Like, I don't even say this to sound so US centric, but for true and animal spirits, investment wise, to come back globally, or CEOs to feel good, or, you know, small businesses to go forth and build and create, like, we need the US to be doing well. And that's why it's a risk right now that the US, yes, we're doing better, but we're kind of last in line compared to other countries that have recovered.
Interesting. Thank you. By the way, I want to mention to the audience, if you have any questions, please throw them out at any time. There's a Q&A button that if you hover over your screen, there should be a Q&A button at the bottom of your screen, and you can type in a question at any time, and we'll
we'll work it into the conversation. I want to switch gears for a second. We're asset allocators. Our clients always have an exposure to bonds. Many of them have managed municipal bond portfolios. When quarantine started happening and everything shut down and it really grinded to a halt, you started hearing on the news worries about municipalities, facing bankruptcy. There might be a surge in bankruptcies because governments weren't getting tax revenues because their employees were being furloughed, forced to stay at home. What is the Market Insights team take on that, the real risk there? Is there a real risk of bankruptcies, or was that, is there something behind the scenes that we don't know of?
So it was very understandable why there was a concern in March. And I can tell you from a financial plumbing perspective, we saw municipal bond trading basically like dry up. So I always say, think of water as money in the pipes, right? And the financial plumbing is the fact that you can go and get cash out of your debit, your debit machine, or a muni bond can be sold, or, a stock can be traded in the market. And that's all the plumbing, the stuff we take for granted because it just works and it happens. Back in March, there was a weird concern around muni bonds because suddenly the water in the pipes dried up and it was hard to trade munis, for example. And this isn't going to impact anyone specifically, but I just want to give you the context. And that's when you started to see concern around municipal bonds and bankruptcies and is this going to work the way we think it is? We've now moved past that. And a big piece of this is the Federal Reserve. So shout out to the Federal Reserve. People have a lot of different views on this, but they've been there for us. They've kept rates low, which we can debate that if they should be so low, but they pumped water into the pipes and they basically said, we will be there to buy muni bonds if we need to. So that's my way of saying the Fed came out and said, we'll support the muni bond market. There is less of a concern now about municipals going bankrupt. And I know there's certain instances like Chicago, which has kind of tricky municipal finances, or Detroit, but for the most part, there's not a precedent of municipals en masse going bankrupt. If anything, you would have the federal government step in. And I hope that's not a controversial thing to say, but that's just the idea that these are still government bonds, and certain muni bonds, some of you watching may or may not know this, but they're backed by revenue projects, and a lot of those revenue projects are up and running again.
Yeah, that's one thing that most people aren't immediately aware of. They hear muni bonds, they think it's funded by tax revenue. That's usually not the case. Many of them are, but there's many other muni bonds that get the same tax treatment, but are sourced and funded through other specific projects. And sticking with the income part of the portfolio, you mentioned the Fed. They've taken rates down to zero in response to just juice whatever economic activity they can. Unfortunately, taking rates to zero, that means that the bond portion of your portfolios now produce less income. They've said they're going to keep interest rates low for a while. So, we anticipate less income from the bond portion of your portfolio. And for many clients, the retirement picture looks like clipping the coupons on your bonds, taking the dividends from your stocks, spending that, using those to supplement your Social Security or maybe your pension. With that lower depressed level, I should say, what might a adapted spending plan look like for someone either in retirement or nearing retirement that's trying to game this for the next few years while the Fed figures this out?
It's a very good question. And it's interesting because these are the things that people don't necessarily want to hear, which I understand, because what can you control? This is what we would say. So our chief retirement strategist, Catherine Roy, who I work with closely a lot, she always talks about this, and it's kind of like, oh no, that's boring advice. Don't tell me to spend less. But it's true, and I even think about it for many younger millennial colleagues I have. I'm like, you got to think about your wage growth, what wage growth is going to look like for you, because there's things you can control and there's things you can't. You can control what you spend, right? You can control your financial house that way. So we would start with that. And then the second piece is, how do we put together sustainable and diverse income streams? We have to get creative. And, and I don't even say this to be pedantic, but everyone who's watching, you're very fortunate that you get financial advice. Like there's so many people that don't have access to financial advice. I'm such a fan of advisors, planners, asset allocation. Like this is all the stuff that works over the long run for us. And so many people don't have access to financial advice. So I think it then becomes it's a conversation, right? For your individual goals, needs, what risk can you take? Can you afford the risk you're taking? Should you be taking more risk? So I know you're asking about fixed income, but I'm going to pivot us over to stocks because I'm of the view we're going to all hold more equities farther into retirement than we ever thought. Like asset allocation is shifting a little bit like that. And it's because we're living longer and we're healthier longer and we're working longer. So I'm not saying that's going to make up for bonds. We still have to have bonds. Unbelievably important. Ballast in the portfolio, their volatility dampening. They just don't provide as much income, so we have to get creative. But whether it's dividend stocks, income strategies, and this doesn't have to be fancy or expensive or complicated, but we have to have thoughtful people who understand financial advice putting that together for us. So I don't know if you would add anything, because I know you're doing this day to day too.
Yeah, well, I love your first comment, control what you can control. And it starts there, and that's where we usually drive the conversation. But one thing I've heard, I think Dr. Kelly mentioned it, also don't be afraid of taking a portfolio distribution. Income just doesn't have to come off the top. We can plan for this. And that's really what financial planners are trained for, is how to make the portfolio provide, not just take what the market gives you kind of thing. So that, very good. Very robust answer. I appreciate that. We have a question from one of our audience members. Where does company size fit in the conversation of stocks? Company size, they're referring to the market cap, large cap, mid cap, small cap. They specifically asked, should they be focused on size? Is one better than the other? Is it important to have all of them? Is one going to outperform the rest?
It's a really, really good question, astute question. So forever and always, small cap was considered higher return, like you would get a premium. So there's these factors that we all look at, and small cap has generally, over the long run, been more volatile, more up and down, but a higher return. So you'd get a small cap premium. And now we're starting to stop and ask and go, is that changing? Is that not? Because you've seen large cap, really big mega companies outperform over the last 10 years. And there's something in behavioral finance called recency bias. This is just like true in life. So this is just like a life bias. We overly weight the stuff we've just experienced. So I can tell you, all the investors and clients I talk to, because large cap has continued to outperform, it's like, is that going to continue to be the case? Because that's recent and I have a recency bias. Do I think that's going to continue on? And I would just say we want to make sure we still have small cap and mid cap in a portfolio, because one, that's diversifying us. And two, you tend to have higher growth from small cap companies. The only thing I would say that might be changing in a post-COVID world is this idea of winner takes all, right? The strong get stronger, the big get bigger. And this is, again, bringing it back to my favorite topic, big cap tech. This is a tech story. Because you think about tech has a lot of barriers to entry, like products you're using now, you're all interconnected. But that might just be true of tech. That might not be true of food companies or, consumer discretionary or whatnot. But it's something we're thinking about this idea of winner takes all, that kind of marketplace. And it might actually suggest that large cap, even though we're not abandoning small cap, but large cap might continue to do well.
Yeah. That's a good point. And while you were talking, it made me think of retail. The whole retail sector has been basically flipped on its head. And, Amazon seems to be sucking in all the business from all the shut down retail, but small cap is where the innovators are usually. And, expecting something to grow out of this external event is a good place to be, sounds like. Another attendee asks, is inflation likely? And if so, how do we guard ourselves against it?
So people are worried about inflation because it's been so low. It's like there must be some rogue inflation hiding behind a corner ready to jump out at us. Like, no, literally, like I've woken up at night.
And we've been waiting for it for 7 years. So,
it's tricky because inflation, inflation's been coming down. So I always say, what stops a wave? Nothing stops a wave. And inflation's been coming down since the 80s. What's been driving it? Technological deflation, right? So that's simply put the idea that technology has made it cheaper to produce things. So think about your TV. I'm obsessed with big TVs. You can get a big TV for $55 now, you know, and like that's technology. Or even oil and energy. People don't always realize this, but we figured out how to drill sideways, which was fracking, and now oil is really cheap, right? And that was technological deflation.
Example.
So that, and then commodity prices, all of that suggests that inflation's going to stay low. But there's a chance it comes up a little bit because it was at 1.5%. Maybe we get up to 3%, but the Fed would like to see a little bit more inflation.
Okay, I'm going to ask a piggyback question. Energy has just been crushed the past 12 months. Does a resurgence in energy, maybe specifically oil prices, boost inflation? Does it affect it at all, or are those unrelated?
It boosts inflation. So commodities and like what we pay for gas at the pump and all of that. Even when I say commodities, think like wheat prices, pig prices, soybean, all that good stuff. That's also feeds into inflation. So that could be a bit inflationary. But I think to answer the attendee's question very specifically, I guess it's this idea: are we worried about inflation because of all of the money and whatnot that we're printing? Yeah. And I would say no. So again, if you think of money like water, which is how I like to think of it, for money to cause inflation, it needs to be rolling through the system, like over and over and over again. So think of like water in a washing machine. It's the velocity of money as it like flows repeatedly through the economy. That's how you get inflation. All this money that we're printing, I know this is going to sound so bizarre and so random, it's not going anywhere. It basically goes and sits in accounts. It's like stagnant pools of water. It sits as excess reserves at the Fed. So the water's not moving, and that's why we haven't seen inflation from all this crazy amount of monetary printing we've done.
Interesting. That's a good way to explain it. Thank you. Switching to kind of the principles of investing, I read an excellent blurb from JP Morgan's weekly publication, and it said one thing that is important to differentiate is investing in value as a style versus value investing. Can you explain those in your words?
Yes. I'm trying to think which one of my colleagues wrote that, because I was like, oh, I didn't write that.
It absolutely resonates with what we talk to our clients about.
Okay. So yes, I mean, value as a style is certain industries. Like it's just kind of a labeling almost. So we consider financials to be value and energy to be value. Those are actually the two biggest. Whereas if you think about growth tends to be healthcare and technology. So sometimes we talk about growth funds versus value funds, and that's one delineation. But value investing, and if I got this turned around, you'll correct me, but okay.
That's right.
All right. Whereas value investing is like a whole ethos. It's a whole way of doing things, of viewing the world, viewing investments. And that's the idea. I want to get things that are on sale, that are higher value than they're being priced by the market, and not getting them cheap, because cheap's kind of a word with a weird connotation, but just effectively getting things that are discounted. And then waiting for them to pop. And that's more around due diligence and like really knowing what you're buying and knowing what the potential is. And that's very different than just saying, I'm going to buy value, which is financials, energy, and a few other sectors.
Yeah. Okay. No, I think you clearly delineated it. Well done.
Big topic coming up is the election. Presidential election, along with many others. I'm going to ask a kind of a nuanced version of the question you always get. Is one candidate winning better or worse for the stock market? My version is what is more important for the stock market, the presidential race or the race for all the congressional seats that usually happen at the same time?
Such a good question. So everyone's hyper-focused on the presidential race,
right,
which I completely understand. This is a really emotional, really loaded election.
Exactly.
Matter, if you're a Republican, Democrat, Independent, like everyone's really feeling this. And I think it's all being amplified by what we're all going through collectively right now. The presidential election doesn't mean as much if you don't get a congressional sweep. So this is the way we've been talking about it, because politics don't matter, policy matters. And how do you get policy through? Well, you need the House and the Senate to get that done, you know, so it's not making light of it. It's not being flippant about it, because I know the presidential election is obviously mattering to a lot of people,
Right.
and it does matter. But for markets, right, we're talking about Vice President Biden wanting to do tax increases. And tax revenues have been very low since we cut the corporate tax rate. Just want to put that out there. So even before we spent all this money on all of the stimulus now, tax revenues have been falling because we cut taxes, you know, and that's like why there had been more of an imbalance coming into this with federal finances. But the truth is, even if Vice President Biden wants to do that, he has to have all of Congress. And same with President Trump, right? Anything he's announcing or not, it's contingent on which way the House goes. So policy matters. Policy has the potential to impact the business landscape and therefore impact markets. But all of the political brouhaha beforehand does not impact markets in the medium to long run. Short run,
Excellent.
only temporarily.
Yeah. Well, thank you for giving us a look behind the curtains there.
That's something I think most people don't realize. We get a lot of questions about the presidential election, and there's an ocean of data behind, well, you know, it depends. So another attendee asked, does the level of US debt worry you? When will it come into play?
So really, really good question. No way to sugarcoat this. Like, the level of debt in this country is
Give it to us straight.
good. It's not good. You know, it's similar to Japan. Well, no, Japan's a lot more, but it's high. You know, developed nations seem to have a lot of debt. So the US is afforded a very special perch, which is often lost on the Treasury, or maybe they know, and that is there's no replacement for US debt in international portfolios. So do you think for a minute an emerging market country could issue as much debt as we do flippantly? Absolutely not. And it's because the most liquid deep bond market in the world is still the US. You know, like, there isn't a European equivalent, there isn't Chinese bonds yet like this, or, you know, even if you thought you really trusted Swiss bonds to be the ballast in your portfolio, that market's just not big enough, deep enough, or liquid enough. So all of that being said, we can keep issuing debt and it does not spike our interest rates. And that's because there's always this demand for our debt. And that's what keeps everything in check. So I guess the point I would make is, we don't ever think that you're going to see, you know, like gold bars and canned goods type of scenario when it comes to the government debt. But is this good for growth? Overall, this is not good for growth, but we've been dealing with this for a while. And I'll just say, you know, it's being issued at insanely low interest rates. So the carrying cost on this debt is not as high as people might worry or think. It's very low.
Yeah. Okay. Thank you. We are nearing the end of our 40-minute session, but I want to ask you one more fun question. In the financial media, you know, we try and coach our clients not to watch it. Is there any one stat or theme or thing that you usually throw in there and talk about
That is just overblown. That makes you grimace and snicker and say, why do they even mention that?
I think it's the points the Dow moves. Like, I find that very random. The Dow Jones is not that many stocks. Like, and they're always talking about the points that the Dow moves, and it's always like thousands, and it seems like a lot. And I think sometimes when I used to, and we will be doing this again, but when I'd be in the airport and see the Dow blasting, I'm like, who cares?
You're
Plus,
right.
like, all of us on the call, myself included, we're all in balanced, diversified portfolios, but they're never blasting that, even though that's really how you transform your income into wealth over time. It's through being consistent, being diversified, being balanced.
Right.
And I'll throw on top of that, I don't think one of our clients owns any Dow Jones ETF.
I know.
So point taken. Well, we've hit 40 minutes. I want to thank Samantha very, very much for being with us today. We really appreciate all the insight you've given us. And it was a good, refreshing take on a lot of topics that are kind of hammered home with our clients, with us, and I'm sure a lot of the investing public. So we appreciate you coming by. And everyone, if you have any follow-up questions for me or for Samantha or her team, please reach out to us. If I can't answer it directly, I will definitely get the answer from Samantha and the rest of the Global Market Insights team. So everyone have a great evening, and please stay safe. Take care.